Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe for multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Hello and welcome to Market Today. You're watching Market Masters, the show where we bring you some of the biggest voices in investment in India and from overseas to talk to you about the way to make money in the markets. And today's Market Master is one of the foremost names in this space in India, Raamdeo Agrawal, who over his long career has seen various cycles of the Indian market and is one of the most respected voices in the markets, the chairman and co-founder of Motilal Oswal Financial Services, joining me, Siddharth Zarabi, and my colleague Sakshi Batra live here on Market Today. Raamdeo ji, namaskar, welcome, Jai Shri Ram. How do you see the Indian market at the moment? Do you see the possibility of further upside from here, given that valuations have risen up pretty high?
Yeah. Good afternoon. As you said, markets are in very good position, and I think slightly corrective mode because end of the year and supply side is building up now finally after a long time. So I think we are in slightly corrective mode right now, but the best is yet to come. I mean, there's a lot of energy in the market. And it is coming not only from the economic performance, which I think most of our economists, they are not able to predict to the accuracy. I mean, they are off by 100, 150, 200 basis point. So that's a kind of a strange phenomenon. We have grown third quarter at about 8.5%, 8.4%. And the economists were at about 6.5% or so. So clearly, I think economy is moving at full pace. And good thing is that economic growth is translating into corporate profits. And that is leading to a lot of tax collection gains for the government. And so I think everything seems to be in place right now. We have huge political event ahead in next 2-3 months, and then big budget. So I think there is a lot to look forward. The best thing is that economy is in a full swing, and corporate profits are also matching with the economic growth. And so long as corporate profit is there, foundation of the market is very, very solid. Now, where the corporate profit is headed, that is what we should discuss, because finally, I mean, market can overshoot the corporate profits or undershoot. But finally, the destination will be decided by where the corporate profit is headed.
Raamdeo, where is corporate profit headed? Are you hinting towards the expectations of a rate cut reversal, which may benefit certain rate sensitives, although real estate, for example, or automobiles have continued to do well despite high interest rates?
Yeah, so of course, those are the things, the global interest rates, local inflation, global inflation. I mean, there are a lot of macro factors which are determining these things. And I don't have a very good I'm not we can't predict which way this interest rate is going to go. Only thing looks to be is that right now we have picked out whether when do we start cutting down, when is the first rate cut in US, and hence when is the rate cut here. So that I don't have a good fix, but it will definitely be helpful if the fixed income starts earning less. It is definitely going to be good for the corporates to earn little more money on their equity, and that would give little more boost to the corporate earnings for the equities. So clearly that will be favorable. And second is that if the interest rates come down, the discounting for the same amount of earnings is also a little higher. So you not only get little more earnings, you also get a little better valuation. So I think we are into that Goldilocks kind of situation where corporate earnings are headed up, irrespective of what the interest rate is. because of various reasons. And then on top of it, there could be a icing on the cake in terms of interest rate cut, and hence you'll get little more booster to the earnings, and also the earnings growth will have more life, because markets are about perpetuity, or maybe 3 years, 5 years. So in a falling interest rate scenario, I think we'll have even more robust earnings growth and better multiples. If today's multiple is 2022, it could sustain even 24, 25. So I think we are into that kind of situation.
Okay, a Goldilocks kind of a scenario. Mr. Agrawal, you did point out that we are, moving forward to the big political event ahead of us. So how do you expect the markets to perform up until then? Also, in case there is a change in the outcome than what is widely being anticipated right now and being discounted to a large extent by the markets as well, then how do you see the markets really pan out? Because you're the best person to tell us. About 4 decades of history is what you've seen. So many elections go by. How have the markets generally reacted to such situations, and what will happen this time?
So we have to go probabilistically. See, looking at the current situation, you have to figure out whether the continuity of the current regime, what is the probability? I mean, there could be some event whereby the probability which looks to be today, say 95% they are in and 5% there could be, or maybe a little less than that. There could be possibility of this is democracy, anything can happen. So 5-10% you can keep in reserve, saying that it may not happen the way you are thinking. But that's only 5%, So we have to, in stock market, it is all about the payoff. You have to see what could be the outcome, 95% chance, and what could be the outcome, 5% chance. So let's not give too much of weightage at this juncture to the 5% possibility. There's always a 5% possibility, but I would not worry too much about that 5% or 2%, whatever that be. And I would focus more on the more likely scenario than more unlikely scenario.
रामदेव जी, चुनाव तक संभावनाएं क्लियर हैं. चुनाव के बाद where do you see returns coming from? Is there likely to be a change in that regard?
ये चुनाव और ये सब जितने इवेंट्स हैं, ये सब होते रहेंगे. 365 दिन में बहुत कुछ होगा, और इस गवर्नमेंट तो और भी बहुत कुछ होगा. मतलब आपका आज ये इनॉग्रेशन है, वो इनॉग्रेशन है, इधर कोलैबोरेशन हो गया. मतलब I mean the paper is full of news, and after that the kind of mood they are in now, they're talking about 4th term instead of 3rd term. So there is no dearth of news, and then we'll have the mega budget sometime in June, July, whatever, sometime in June. So that will set the tone for the next 5 years execution plan. And see, one other thing is to get in the head, in our mind, that one is of course the current leadership team and the kind of with confidence they are executing. But one has to understand that economy is a compounded machine, ultimate compounded machine. So in 75 years, it took for the economy to come to say $4 trillion. This year would be about 3.7, 3.8, whatever. So it has taken 75 years to come from 1947 till date to $4 trillion. But in next 8 years, you will do another $4 trillion. So the change, when you go from 1 to 2 is also doubler, and when you go from 100 to 200, that's also doubler. So today our journey is going from 4 trillion to 8 trillion, and that will happen between 2030 to 2032. So that's the main thing to be focused on. When the economy moves from 4 trillion to 8 trillion, what are the industries, what are the businesses, and where exactly we are going to make a lot of money? Where exactly scale up in the corporate earnings are going to happen, and where market is not able to see what is going to happen. Where is the trend, big trend? Those are the exciting thing. And of course, on the way, you are going to see utterances of say budget. In budget, they will talk about a lot of capex. In their hand is what is there. They have to talk about the capex in the economy, whether defense, whether it is infra, whether all sorts of whatever is left out of their revenue spending, interest and whatever, running the government and all. The whole thing is going to go in the capex side. What we have to figure out is at what point of time the private capex in the economy, that is going to start. Because then you are talking about the government capex and private capex both coming together, and the economy again taking from say even 7.5%, 8% to more like 9.5% type of thing. There could be overheating also. So I think a lot is happening in the economy. I don't see many negatives in the economy. Always you can find consumer demand is a little weaker here, there. There will be some segment of the economy which may not be doing well. But right now, I see very broad-based recovery happening in the economy.
Okay, a broad-based recovery in the economy. But since you're talking about the doubling of the economy to say 8 trillion, are you also looking at doubling of the Indian markets from where they are currently? I mean, by when do you see, the Sensex and the Nifty really doubling from the current levels? Can we see a 50,000 on the Nifty over the next 5-6 years?
Should be, I mean, we are at 22,000. So even if you get at 15% compounded on a 5-year basis, you're talking about 45,000. So, yes, I mean, 5 years is 44, 45. 6th year should be more like, so you are in 24. 2030 should see, we should kiss 50,000 Nifty in 2030-31 for sure.
Okay, Raamdeo ji, there are several questions coming in from viewers, and on this show we always take those with you. Sudesh Palwal from New Delhi is asking a question: what are the common mistakes that retail investors should avoid when they are trying to build a portfolio?
Yeah, so one of the things is that it is a small investor. So investor must, first thing is remain invested. One of the things is that you time the market, that is it all-time high, so should we book the profit and get out? It will always be all-time high. Like you are at today, say 22,000 and 22,000 some 300, 200, whatever. And you are at all-time high, but you are all-time for last 75 years. You're not at all, nowhere close to all-time high for next 6 years. So you have to focus on the future rather than the past. So in next 5 years or next, I mean, if you're a long-term investor, you must look at 10 years. So in 10 years, you could be talking about 75,000 Nifty rather than Sensex. So you will always, so you have to remain invested in the market. Then within your portfolio, whatever has become fully priced, overpriced, and you have better ideas to buy in, you can shuffle your portfolio, but don't get out of the market. My sincere request for all the investors would be, Indian market, you cannot time it. I mean, no market can you time it. But this is a roaring market. Don't get out of the market. Shuffle your portfolio. Whatever you understand is underpriced, and stay with the quality. Because at the end, when the bull run gets over, what happens is typically common investors, they are stuck with the bad quality companies, and blue chips go to the institutions. So please don't have that situation in your pocket, because one day this bull market will come to an end.
Okay. I hope not soon, sir, because it's a party that we don't want to get spoilt anytime soon for the investors as soon as possible. Yeah. Let's take the other question with you, sir. That's come in from our viewers. From Noida, Zainab Khan is asking you, how should I invest amid elections and political news taking center stage now?
Use every single opportunity of this kind of, unimportant news flow hurting the hurting the sentiment of the market. I mean, of course, market is trying to encompass all the news, but if some kind of political news which has no bearing on the performance of the economy, performance of the corporate per se, but it just hurts sentiment of the market, I think those are the times to be used as an opportunity to buy more into the stock where you are convinced about.
That's a good point, because instead of focusing on vote share and other such election data, the focus perhaps, as you were saying, Raamdeo ji, should be on ROE and ROCE. But the question I have as a quick follow-up, in a market that is at all times high, and you made this point that markets are always at highs, is it possible to get good returns in such a scenario?
Yes, I mean, see, you are buying at not a, depressed market. You are buying at a, I would say, fully priced market. So in that case, your return expectation has to be moderated, particularly for the shorter term. I mean, like if you're looking for 3 years, I would say don't expect more than 12% compounded, 12% per year. And there is a possibility that even that might become a little challenging, maybe 10 to 12%. But if you talk about 10 years, then you'll start looking at 13, 14, 15% compounded. So clearly, the short-term returns would be somewhat slower because you just got 27-28% last year. See, year before, 22-23, yeah, 22-23 was zero return for the index.
Yes.
Okay, so that was followed by 23-24, which is 25-27%. Am I correct?
Yeah.
Okay, so
Absolutely.
now on the back of 27-28%, the long-term average is 14%. So you got little more than what you should have got last year. So that you have to make up next year or year after. So right now there is a lot of excitement. But now you see the selling building up. Like Indigo is taking up 5,000-6,000 crores in one shot.
Yeah.
You know, so, I mean, you see how many blocks are happening, how many IPOs are happening. Relentlessly, that is very good thing. It is the best thing. That is the purpose of the market. Purpose of the market is to value the earnings and also provide liquidity to the or capital to the corporate world. I mean, if we don't, this retail revolution which is on right now, where 4 to 5 million customers are coming every month into the market. You know, they are bringing anywhere between 1,000 to 2,000 crores per day, Saturday, Sunday included. Now that liquidity has to be absorbed. So if you are bringing 2,000 crores per day in the market, you also need 1,000 to 2,000 crores worth of new paper. Now, from where the new paper will come? Either it will come from IPO, it will come from the existing companies by a follow-on offering, or it will come from the promoters, or it will come from the FIs. So all of them are supplying the paper. And despite that, market is going up. So that's the beauty of the market. Market is horizontally expanding thanks to retail boom. And my sense is retail boom is not a 1 quarter or 2 quarter phenomena. It is going to be a decadal phenomena.
Oh.
Okay.
Yeah, it is decadal phenomena, and nothing happens in a straight line. It will have its own, highs and lows in terms of number of people coming in. The moment market goes a little depressed, if there's too much of supply, market may correct by 10-15%. At that point of time, retail also will shy away. And then the supply will stop. And then again, kind of market will start moving up, and then you'll see the retail again coming back. So this, this entire thing, this is what I'm thinking. I don't know how exactly things happen. We have never seen it. This for the first time in the history, at least in 40 years, I am seeing for the first time influx of retail boom. I mean, from 40 million to 150 million, and we are headed for 300 million in next 3 to 4 years. So this particular force has to be harnessed by the economic managers also, the North blocks, the regulators, the market participants, intermediaries. Everybody must harness this because this is one of the most potent and most valuable force for the economy. I mean, it can transform the economy, the pace at which it is coming. We have to harness. This is like a Ganges going to Rajasthan desert. Now it can have a devastating effect of flood, or you can harness to make it a green revolution.
That's a very, very a good point that you make, Raamdeo, and I hope North Block will take notice of this, if not now, but after the election results. There is more questions that are coming in, and since you touched about new paper, a question from Faridabad from Hitesh. What are your thoughts on the recent IPO performance and that big question that is always asked, retail investors, and how should they go about selecting the IPO from this rush of paper?
Yeah, so as far as the IPOs, I'm not a big fan of IPO because most of the time, I mean, for my size, first thing is to get allocation is a big problem. Even if you like something, you can't get what you want to buy. You want to buy 5, 10, 15 crores worth of stuff, you can't get. Because the allotment system is such that, but for retail, yes, it could be a great opportunity. But if you're an investor into the market, there is no difference between a listed company in the same segment and a new company coming from IPO. But there is a lot of excitement about the new companies because their time of listing, because of scarcity of supply and a lot of demand by the institutional investors, you always see 30-40% pop, and that becomes a big attraction for the retail to apply into the IPO and make that one-time kind of a casino kind of gain in the IPO. So if you are looking for that kind of one-time gain, obviously the game is on. Look at the premium and go after subscribing, whatever is the economics. But I think if you are an investor and you want to build a good portfolio of companies, sensible companies, there is fundamentally no difference between shares bought through IPO or shares bought through secondary market. So you can see if there is a company which is completely new, some digital companies coming to the IPO, and that kind of company is not there in the market. Obviously, you must look at it very peacefully, whether this company has the merit of, because what happens is in the completely new segment, even the market is not aware of the prospect of those companies.
Yeah.
So if you as an investor, you have better understanding of that particular company or the industry, of course you will have an edge over the rest of the pack in buying those stocks in IPO.
But Raamdeo sir, since you said that allocation is a big problem, of course for big players like you, but also for retail investors, they usually end up not getting the IPOs that they are looking at, and of course there is this overheating of huge subscriptions that we are looking at. Do you think there is a need for regulatory intervention here? Some kind of changes that are required in the IPO space?
I think they have made the market very efficient, T+C listing, and all kinds of regulatory action is on. I mean, they have made the entire process very efficient, and now it takes just about 2.5, 3 months to get it cleared. And I was surprised when I heard that SEBI's mandate is now capital formation. So the SEBI is doing everything to see that deserving IPOs, they get cleared very quickly and get listed. So I'm not as I said, I'm not from that iBanking background.
Sure.
So the guys who are handling IPOs, they will be able to guide if there is any, and I think they have a good listening in SEBI if there is any proposal to be, anything to be kind of a changed for the better working of IPO process. I think they would be willing to listen.
We've got a question on PSUs, and that sort of is from Noida, Baldev Singh. And I think the question from Baldev relates to the broader point about the PSU space and whether it is overheated. He is asking, is there steam left in the PSU rally, and is it too late to enter that segment now?
Yeah, so I think PSU has been discarded in last 15 years, 15, maybe even 15, 17 years. But the last decade, last 10 years have been horrible for PSU stock investors. What used to be almost half the market became literally zero in terms of incremental wealth creation in last 2-3 years. And then to make up the whole thing, I think it has come back with a big vigor in last 12 to 18 months in terms of it is the best performing segment of the market. And so now I would say that don't differentiate between, don't call it a PSU or non-PSU. I mean, you don't differentiate based on that. If a PSU stock is great, if it is a good capex company like BEL or AL or whatever, I mean, the unique companies from PSU, look at them on merits. I mean, don't make it, I mean, whether it is a private sector or public sector, look at the companies on its own merit. Don't give them negative marks or don't give them positive mark for being PSU. I mean, just because it is a PSU, but if there is no earning, you can push them up to any price in this current bull run. But I don't think that is going to take it very far. They will finally fall flat. Even if it is a PSU, but badly performing PSU, I would say look for a performing PSU and then don't differentiate between a performing PSU and a private sector bank or some other capex companies. So I would think that the blur between the private and public will go away for very good PSU companies.
Okay.
Right. We've got one more question from Bengaluru. Raghavendra wants to know from you, sir, which are the top 3 themes that you believe will be outperformers over the next 5 years?
Yeah, so these themes keep emerging depending on the global forces of businesses, say tomorrow by chance oil collapses from 80 to 40, there'll be a whole lot of new opportunities in the marketplace. So you have to keep looking for disruptions. There is always an opportunity in disruptions. There'll be one set which will get hurt, but there'll be another set which will be beneficiary, of value migration. So, but currently what I look at, I mean, what I'm seeing and what do I understand is that one is the tremendous buildup of infrastructure in next 5-10 years in India. I mean, the scale will be, I mean, unbelievably big, and it will be very quick, because what PM is saying is that I will lay the foundation and I'll inaugurate also. So you're talking about 4 to less than 5 year kind of a tenure for any project announced, and the amount of money available to them in next 5 years is going to be like we are talking about almost $1 trillion of capex possibility in next in infra in next 5-6 years. So I think this is very interesting kind of a phase for capex, and market has already rewarded all the companies busy in them. But my sense is the best is yet to come in terms of the capex buildup on the infra side. So is in the nation of the defense procurement. So these two are looking very big. Third, I would say, and I would say even the first, is the capital markets. Because of this retail revolution, by inclusion of the millions of people coming every month, my sense is there is once in a lifetime opportunity to build on the capital market participants, whether it is brokers, asset managers, wealth managers, depository participants, exchanges, you name it. All of them are going to have fantastic time, and they are asset light. They are not very capex driven companies. So I think their return on capital is very high, size opportunity is very large, and good thing is that this time the liquidity which is coming is not a temporary liquidity. The SIP which is coming, I don't know whether you all are aware, the SIP with their underwriting is a 30-year paper. I mean, the guys are sending SIP for commitment for 30 years. I mean, earlier it used to be lifelong. Now I think they've restricted to 20 or 30 years. So these are the crazy numbers which are going to come. Last month was about 19,000 crores gross SIP addition, and 26,000 crores or 27,000 crores inflow into mutual fund itself. So I think we are looking at a much more larger number. I would not hazard a guess where exactly this number is headed. Suffice to say that from 2-3,000 crores per month, it has gone to 19,000. 6x in, I think, 7-8 years or something like that. So there is a crazy build-up. So I think capital market opportunities are exploding. That's a segment where I would think it's a bit cyclical in character, but that's a good place to make money apart from the capex thing. And then finally, somewhere along the line, the consumption will pick up. The trickle down has been a little slow, but I think 24, 25 and the post budget, I think the finance minister will definitely take notice of the weakness in the consumption, and let's see what happens in the budget.
Since you mentioned weakness, do you think that the optimism overall, broader markets is showing some signs of fizzling off, especially mid and small caps, because the advanced decline ratio also seems to be pointing towards some weakness?
Yes, because first thing is it was overdone. So it is correction to the boom. I mean, it is a correction to the massive performance. So that is one thing. Second, I mean, it better corrects, it better corrects. Otherwise, it will become very unhealthy. So, so I think it is a very well-deserved correction. And when the valuations have also gone little haywire, vis-a-vis large cap. So one thing you must understand, the market is very structured. The top 100 companies earn 75% of all the corporate profits in the country. So typically, you should have 75% of the market cap in the large cap. I mean, I'm talking about maybe 73, maybe 78. But that ratio should not get vitiated. Right now, it has come down to 63%. And that is a source of trouble. Your rest of the pack, mid cap and small cap might be earning about 5-7%, but that has become maybe 15-20% of the market. So this anomaly of a higher valuation for small cap segment and mid cap segment compared to large cap, that anomaly, I don't know how market will correct, but market has its own way of correcting. Let's see how it goes about.
Okay. On this itself, sir, we've got one viewer question, so I'll take that with you. From New Delhi, Chaitanya Kumar wants to know that I've made decent gains of about 30-40% in the recent run-up in the market. Should I book my profits across stocks and mutual funds or stay put?
No, you must stay put. And that's what I was saying at the beginning itself. And you should be willing to see 15-20% correction.
Okay.
In my lifetime, in 40 years, I have seen 4 corrections of 50%.
Wow.
In 92, I fell by 67%. In 2000, I fell by another 60%. In 2008, I fell by 50%. In 2018, pre-COVID, again, we fell by 45%. But I stayed on. And that's what allows you to really fly. Because in 1 year's time, you'll get not only 20% back, but you'll go higher than that. So why bother about it?
We spoke about political risk at the start of the conversation, but beyond that, do you see any potential risk that especially the retail segment should be looking out for?
See, now the way supply is building up, the supply itself can become potential risk for the correction of the market, I'm saying. You know, apart from political, I would think more the pace at which the supply is building up, and people are in hurry before everybody wants to take the money home before the election outcomes. So, I mean, that could be one reason, and that will be very healthy, I would say. In fact, if supply doesn't come, I'll be extremely disappointed. Then our market mechanism is not working. When something is 100 rupee thing is selling for 120, 130, 140, I mean, the guys who are holding the stock, whether it is a promoter, whether it is a FIs, whether it is government, I think they must dump it.
Okay, Raamdeo ji, there are many more questions that are coming in, but I know you are running out of time. One quick comment from you, because this is a question that is being asked about the broader issues in the NBFC space, fintech space after the RBI crackdown. Any thoughts on that, and whether that bears any lessons?
Of course, I mean, you can't be taking first thing the regulators lightly. That message is very clear. Absolutely clear that if there is a sneezing from them, you've got to be really, really alert onto catching those kind of directions from them. They're well-intentioned guys. They don't have any agenda in life. They just want to, they're scared of market going berserk. You know, basically they don't want some bank to go bankrupt or some other scam erupting here or there, and they're caught unaware. That's what they're trying to nip in the bud. So you have to help them as a responsible participant and don't fuel. I mean, the greed for making money as a corporate, greed for making money as an investor in this kind of market is very high. In fact, the guys who make more money, they have more greed than the guys who are not making money. So how do you control the greed? And the job of this greed control mechanism is given to all the regulators. You know, so you have to be very careful, because the journey is going to be big. And journey should not be spoiled, you know, because in compounding, you should not break it. That is very important. In compounding, you must not break it. And the return is going to be compounded. So, I think the corporates, the investors, the participants, everybody should ride this compounded journey of India, compounded wealth building of India. And regulators should also be very careful. They should not hit the guys so much that we get unnerved, in the sense that because customers are coming. I mean, our interest is to serve the customers, and at times customers go out of hand. So we have to be taking care of our house very well, so that regulators are happy with the housekeeping. I think we have to be extra clean. You know, it's like a COVID time, so your house has to be far more cleaner than normal time. I would get that message right, absolutely.
Absolutely, Mr. Agrawal, thank you for that message and many other key pointers that you provided us during this conversation. Viewers, that was Market Master Raamdeo Agrawal answering your questions and giving us a sense of how there is money to be made in the markets, and money that is to be made cleanly and with patience. Once again, thank you very much. And with that, it's a wrap from me and Sakshi Batra. We'll see you again. Until then, goodbye.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.